So good morning. My name is Peter Shelton. I'm a partner at Benish Friedlander, Copeland & Aronoff. We're a Cleveland-based middle market law firm, about 330 lawyers in Cleveland, Chicago, Columbus, San Francisco, and Wilmington, and then a few people scattered around a few other places. But those are our primary offices. We're a full-service law firm, but we have a very robust middle market private equity practice, and we represent businesses and investors up and down kind of the ecosystem of private equity, committed capital funds, both large and middle market and lower middle market funds, a number of independent sponsors as well. Thus our interest in this conference, and lots of family offices. So I spend most of my time doing deal work in the middle market and lower middle market arena with all those different sponsor groups. So we've got a great panel here, very diverse kind of mix of representatives of both independent sponsor world, capital providers, investment banking, as well as consulting. So let me kick it off and start with David to my left to do a quick round of self-introductions, and then we'll get going.
Sure. Oops. And well, thank you, Peter. I'm David Acharya with Acharya Capital Partners. We are a New York City-based private equity group focused on the lower end of the middle market. I've been an independent sponsor for probably about 15 years. I actually am old enough to remember the term fundless sponsor, but over the period of time, we became known as independent sponsors. And I've done numerous platforms, add-ons, working with a network of family offices, ultra net worth individuals, as well as other funds, and really looking forward to this conversation. Thank you, iGlobal Forum, and all the sponsors for putting this event together.
Next. Great. So I'm Pat Tonolfo, the Managing Director of Actel Advisory Group. That name might be unfamiliar to the crowd here. That's because we've recently rebranded. We were founded as Bassett & Associates in 1989. We're a commercial due diligence provider. We've been laser focused on the lower middle market and middle market for really the last 20 years. We have also worked traditionally with more committed funds, traditional PE groups. So this is a new crowd for us. We're excited to be here. You can put us kind of in the same swimming pool, if you will, as LEK, Bain, BCG in terms of our role in a process. We're brought in to help our clients and the various folks involved with the deal process understand, are you putting your money to work in the right market? And probably more importantly, are you backing the right company within that market? We focus more on very granular information pulled from customers, competitors, suppliers, and other market participants to kind of paint a clear picture of what is the competitive advantage of the business that you're investing in, how sustainable is it, and can that company continue to grow in the face of some uncertainty, which is going to be kind of the topic here today. We looked at 85 deals last year. We're 9 full-time consultants, and we work with about 35 regular kind of clients. I think we probably worked with well over 100 over the lifetime of the company. We're excited to be here, and thanks for having us.
Hey everybody, my name is Drew Brantley. I'm with First Capital Partners. We're a boutique investment bank, been around for 25 years. Since inception, we've specialized in raising equity and debt for independent sponsor transactions. Really look to help shepherd the transaction from start to finish all the way through. So excited to be here today.
Good morning, my name is Grant Korneman. I'm an independent sponsor from Dallas, Texas. One of the co-founders of NCK Capital. We have 5 companies in our portfolio today. Last year, we bought one and sold one. It's way more fun to sign the back of the check than the front of the check. We focus on businesses with $2 to $10 million of EBITDA, solidly controlled investors. We hunt for companies in the service sector, niche manufacturing, value-added distribution, and for-profit education. And looking forward to talking to folks today.
Morning. I'm James Illickman. I'm with Peninsula Capital Partners. Firm was founded in 1997. We're based in Detroit. We are focused on providing capital to independent sponsor-led transactions. We've done approximately 70 independent sponsor transactions now. And our model is to provide the entire bottom of the balance sheet so we can be as active in raising the senior debt as well, but we want to provide all the mezzanine and all the equity that the independent sponsor doesn't want to commit to. So in most cases, we end up being a substantial majority owner. We've got transaction partners. Well, so kind of agnostic of that.
Terrific. Thanks, James, and thanks, guys. So I guess to kind of briefly frame the discussion and the topics at hand, thinking about where we are at the end of the third quarter right now in 2022 versus where we were a year ago. I mean, at this time last year, we were telling our clients that, they were running out of time to get deals done because there was no longer, there were no longer rep and warranty insurance policy dollars available. Those had all been used up. The accounting firms couldn't get to QOVs fast enough, and it was a frenetic world. We did, at my firm, we closed well over 200 transactions on behalf of clients last year, and it was crazy. Everybody was worried about capital gains rates going up, and we didn't have all the headwinds that we seem to have right now in 2022. So thinking about kind of deal making and portfolio management in the current environment is kind of our first topic. And we've got the war in Ukraine, we've got still lingering COVID, I think, for sure. We've got interest rates going up, which, by the way, at the end of the panel, you guys can think about what your answer is going to be. I want to do a lightning round and see what everybody's predictions are on the Fed rate increase that it's going to get announced at 2:00 this afternoon. So we'll see what the panel predicts. So anyway, with those kinds of things in mind, Grant, let me start with you. Just kind of thinking about those big risk issues that are out there. How does it impact your view on investing, portfolio management, all of that?
Sure. I think 22 has been the most challenging year to underwrite EBITDA that we've ever encountered. We've seen companies with pricing increases that have generated more margin, but they're not annualizing their expenses, which are going up. Earlier in the year, the TTM numbers seemed like they included a lot of business that was pushed from 20 to 21. Depending on how you feel about the future, one may argue that the next 12 months may be less rosy than the past 12 months. And so we found to be a very challenging year to find investment opportunities that really had conviction around. And unlike our funded brethren who get paid management fees regardless of how their portfolios perform, we independent sponsors, if we buy a business that doesn't do well, we have the lovely opportunity to work for free until we fix it. And so, we take the downside very seriously at our firm. With a full portfolio and a small team, we have to be very sensitive to the return on our time. And so we've been a little bit more defensive this year than we have been in years past.
Okay, makes sense. So others, I guess maybe David, from your perspective in terms of your fund and.
Yeah, so I think Grant said it well. The one thing I would add is just because there's war, just because there's rising interest rates, doesn't mean deals don't get done. Like, we don't stop. It's just that how we approach risk is a lot more deeper than how we probably look at a company in 2018. I mean, one of the big things right now when I look at companies is when I look at the current projections, how much of that was just business that was pushed and what will be the normalized EBITDA going forward? And what I find now is companies, I'm not sure, are articulating that right. And I think the companies that can and show, listen, COVID was a way how we do business very differently, okay? And if you can prove that and prove that it's a whole new paradigm going forward, those are the companies that are attractive investments. But the companies that are showing great EBITDA in 2022, well, is that EBITDA really 2021 and 2020 EBITDA that's been pushed to 2022? That's the big, risk question now. But as far as, calamities around the world, I mean, I've bought businesses during wars. I bought businesses during rising interest rates. I bought a business in 2008. So just because there's some economic activity going on, I actually view that as an opportunity. So not that I'm going to buy businesses back and forth, but the diligence and the risk parameters are a lot more greater, but doesn't mean that business stops.
Yeah. Right. And so Pat, yeah, I was going to turn to you.
Yeah,
'cause
I
this-
think I can piggyback on David's point. You know, I think that we've definitely seen velocity slow down a bit, but in some ways, if you're looking at this as a more of a glass half full opportunity, it's in 2021, the deal model was this. We just got to hurry up, write the check and go, right? There was so much competition. You weren't really afforded the time necessarily if you wanted to sign a deal up to be diligent about understanding the business, understanding the founder that you were backing, his or her vision for the company moving forward, right? Because it was a little bit like buying a house in 2021 in Brooklyn. You better come with your cash and no, you don't get to see it inside before you buy it, right? You got to buy it and go. Now, what we're seeing our clients, you know, where last year we might have only had 10 or 15 days of exclusivity to do some work. Now we're getting 20, 25, 30 days. We're getting to take our time, look under the carpet a little bit, check for wood rot and make sure we really understand how we're committing our capital. And so I kind of believe what David believes and that periods of volatility and high uncertainty often represent good opportunities, right? If you're coordinated in how you do your research and you're coordinated in the partners that you bring to a process to unlock some value, right? Where others might not, or where you might miss out on it in a year like 2021, where velocity was just so strong and competition was so high, you might not have had the time and the resource availability, right? I think as Peter said, nobody could do any work in 2021. So by the end of it, so no, I would agree with David that 2022 feels more like an opportunity to me than it does necessarily a roadblock.
Good, terrific. So I don't know, James, anything you want to add on to that
I don't know
thread?
if I have anything to add on other than, you know, what we've seen, and we were in somewhat of a fortunate position of having a larger portfolio of companies, so we're always adding new investments and harvesting old ones. We get to see both the kind of the buy side and the sell side. And the transaction process is, in the last 6 months, has definitely been extended. So I think buyers are more cautious. They want to do more due diligence. They want to understand, you know, the end markets. They want to understand what the supply chain issues are. And we're going to get to that in the following question. But there seems to be a lot of interest because there's always more dollars chasing than there are deals to be had. But there's an increased level of caution to make sure that they're understanding what's driving the performance of the business. And if the performance is elevated significantly compared to the last couple of years, why is there the kind of proverbial pig in the python? Or if it's still kind of a slow recovery, how does that company compare to its brethren in the industry? So we've taken advantage of it on new investments, but in deals that we're exiting, you know, it's been a little bit frustrating.
Have y'all seen higher multiples in companies that you can answer those questions with a little bit more confidence? You know, when we're seeing businesses where you go, they'll absolutely do well next year, they'll absolutely do well if there's a slowdown in the economy, the numbers are clean, the valuations are just through the roof for those opportunities. And are we the only ones seeing that, or what's been y'all's experience?
I think we've seen a flight to quality, but you know, in similar comments, you know, in processes where we're exiting, where you have a lot of clear view of what buyers are doing, there's a lot of initial interest at high valuations. But if the quality is, you know, a little bit questionable, some of those valuations start to contract as they go through the process. So you might start with 20 IOIs and you end up with, you know, 5 LOIs, and the LOIs, you know, are at the low end of the valuation range and lower than what the IOIs came in at. So I think if it's a incredibly attractive, high quality asset, yeah, I think the valuations are high because there's so much question about sustainability in businesses that don't have those same characteristics.
Yeah, and one of the things we're seeing kind of to that point is that a lot of our clients that are being disciplined, maybe they put a bid in it, I'm making numbers up here, but call it 6X because that's what they think the business, you know, should be underwritten at. And it goes for 8 times in the initial round. Well, then something happens, something gets shaky, things come back around. You know, I can think of probably 2 or 3 deals in the past 12, 18 months where our clients hung around the hoop, they were disciplined about their underwriting approach and where they bid. They weren't just going to bid it up. Somebody else bid it up and then it came back around and they got a second shot at it. So, I do think, kind of to echo what was being said up here, for the independent sponsors that are being disciplined and really finding good quality deals, the plus side is there's a lot of money out there that has to be put to work right now. So when you do have a good quality deal, there's no lack of interest, I think, in a good quality deal.
So thinking about valuations and pricing businesses, how in this inflationary environment, how do you guys approach and think about earnings spikes, inflationary earnings spikes? I just read something this morning about, the automakers are front and center on that, right? They've been able to, their costs are going up for getting vehicles, or the dealers, but then they've been able to mark up their prices considerably. And so we've got, huge, one component of, all these inflationary pressures from that, big sector of the economy, from automotive. But, as you guys look at businesses that you're, and so I guess this is, sort of relevant for everybody on the panel, but certainly, James, as a capital provider, how do you think about, evening that out?
The earnings spikes are one of the toughest things that we're dealing with right now, because some of it's inflationary, some of it's supply chain, trying to decouple those two. I actually think the supply chain piece of it maybe is a little bit easier to understand, because you have customer intimacy. So if you're going through a due diligence process and you're working with the management team of the target, and they have a good understanding of the customers, what the customers' buying habits are, what their end markets are, we're trying to do some work to understand. For example, we're looking at a consumer products business right now, and the end market is pretty transparent. So we're looking at, what's the buying habit in that end market? Are consumers buying more of this item, today than they were in 2019? And we're trying to use that with just some statistical analysis to try to figure out, so is the customer of our target just buying inventory ahead to try to get ahead of the supply chain, and what's that doing to the overall crisis? And we've seen, several instances of that. And then just on the pure inflation part of that, that's more challenging to understand, is what's driving the inflationary, pricing pressure. You mentioned the automotive industry, and that's pretty tough. I mean, we're a middle market investment firm, so we're not investing in billion-dollar companies. So if you're participating in the automotive industry, you've got big customers and you've got big suppliers, particularly if your raw materials, commodity like steel or resin. And you're generally in an unenviable position where you can't dictate the prices to your customers, and you really can't influence the prices from your suppliers. So, but what we want to see is companies that they're managed very well, and so that they can either stay on par with their rising cost increases and pushing those through to their customers, or maybe even, maybe leading that a little bit. But it's probably the number one issue that we struggle with right now in underwriting.
To add a little color there, a lot of these companies have been able to push their costs onto their customers with a margin. Then we saw them be able to push their prices, but not get extra margin on it. I think we're entering a phase now where we can't push prices, but our costs are going up. And so that kind of final ending of inflation is a tough one to underwrite for sure.
Anybody else?
Yeah, on the inflation side, we can probably speak less to that, but I think, every engagement that we've worked on this year, the cornerstone of the engagement is how do we understand the growth of the business that we're looking at, both from a top line and EBITDA perspective over the last 12, 18 months, real versus nominal growth, right? And I think that our best clients, our most successful investors, do the best job of pooling their resources together to answer that question in the most thoughtful way that they can. So, we've worked in several deals this year. One in particular jumps out, where the company had a pretty unindexed, probably overweight exposure to club stores. This is a provider of consumer goods, more heavily weighted towards Sam's, Costco, BJ's than it probably should have been, and it may have been penalized for that in 2016 or 2017. But because club outperformed, traditional grocery, traditional retail so significantly over the last 12 months, all of a sudden, the seller, I think, comes to the table with some expectations of getting paid a multiple that, was probably unrealistic at the start of the process. So, being brought in and trying to understand, okay, well, within the club space, right, how much of that growth that we encountered over the last 12, 18 months is due to just purely rising membership rates at club stores versus did we take wallet share from another supplier at BJ's because they were having supply chain issues? And are we going to give that back in 18 months, right, when this other supplier kind of gets itself together? Are we getting more shelf space at BJ's and than we used to because of some transient trend, right, that might go away? And then how do we kind of model that out on the next 12, 18 months? And what it does is it's this iterative process, right, where we're interfacing with folks like David and lenders to try and kind of refine and get our arms around, right, what's real over these last 12 months and what's underwritable, in the future versus, I think someone used pig in a python, which is not one I've heard before, but that's the central question, right? And I think about everyone in this room as, getting a deal done. You guys are like conductors of orchestras, right? You've got to make everybody land on the same note at the end. And if you have a thoughtful approach to the diligence process and an analytical one, these questions you can get your arms around them, right? But you have to have the resources available that you trust to kind of coordinate together to answer the questions.
Sounds great. David, anything you want to add to that? Or we kind of
covered it well.
Okay. Okay, so switching gears to the topic of buy and build strategies, which I know at my firm we see a lot and help a lot of clients with, in particular industries that jump out. HVAC currently, landscaping, certainly DSOs. We do a lot in healthcare. So Drew, let me start with you. I mean, in terms of what you're seeing as you're helping put together capital providers and sponsors, what do you think, what are you seeing in terms of successful kind of buy and build strategies, geographically, industry wise, what works, what doesn't work?
Yeah, it's a great question. So probably 80% of the deals that we do are buy and builds of some nature, whether it's 2 or 3 companies coming together out of the gate in the initial transaction, or they're buying a platform and then looking to do acquisitions as a core part of the thesis. And I would say one of the things that we've seen through the years is that there's really kind of 3 core things that capital providers want to latch onto and get their hands around. So for independent sponsors that are thinking about doing one for the first time or thinking about it, these would be kind of, there's obviously more, but these are kind of the 3 core areas that everybody gravitates to or questions out of the gate. The first one is people want to be able to identify one of the companies as a platform, even if it's not fully complete. A lot of times capital providers like to be able to say, okay, this is going to be the platform that we're going to build off of, and here's a reason. It's got, people or systems or processes or size or whatever it is, customer base, but there's one of them's going to be a platform. The second one is who's going to lead this thing. Who's the CEO and the leadership going to be in? And oftentimes I think that's the piece that maybe is a little underestimated by some independent sponsors, where they think, oh, well, we'll buy this and we'll figure it out later. Well, the leadership, capital providers really want to know who's going to lead this thing and who's going to be in charge. And so either somebody internally at that business, needs to be able to step up if the leader's stepping out, if the owner's stepping out and they've been running it, or you've got to have somebody teed up to be able to step into that C-suite. And capital providers are going to want to know who that is. The whole, oh, well, we'll do it 3 or 4 months after close, really just doesn't cut mustard. And then the final piece, really the third piece, is the integration. How are you going to put these things together? Because just show of hands, who in here has either been a part of or done a buy and build themselves, just out of curiosity? Okay. So anybody in here that just raised their hand, or anybody that knows somebody that has a story of a buy and build that went down in a blaze of glory like the Hindenburg because it was held together with duct tape, okay? And so that's everybody's biggest fear, is how are you going to put these things together? And groups like Peninsula down here at the end really key in on that when they're doing due diligence and when they're talking to independent sponsors. And we see it not just with them, but with most capital partners, is what's the integration strategy? How are you going to pull these things together? And not just saying, oh, well, we're going to do 1, 2, or 3, but really having kind of 2 or 3 levels deep of kind of how that plan is going to go. So those are kind of the 3 categories for folks that are stepping into it, that if you're doing one for the first time, you really have to have your hands around kind of those 3 elements of it. In terms of industries, You know, we do buy and builds in all types of industries. I would say broadly speaking, again, this is a, you know, asset-light business services is the sexy thing that everybody wants to see. As an overall arching thesis, but obviously plenty of opportunities outside of that as well. But yeah.
For sure.
I would add to that with this point about integration. If you think about it, things you got to buy it right, you got to run it right, you got to sell it right. You have to get all three of those well to take investment. Buying it is, I usually find that's the easiest thing. I mean, they're all difficult, but buying part of it is the easiest thing to do. Maybe it's honestly, but the integration is usually the most difficult. And you know, it's challenging from a personality standpoint. You know, when we look at buy and builds, you know, we really want to find ones that are scalable as opposed to collection. Right? It's easy to buy, you know, 6 or 8 or 10 companies that are collection, but they're not scalable. There's no synergy together, whether it's, you know, rationalizing the businesses from a cost standpoint, whether it's, you know, geographically expanding your customer reach, or your service offering. But there needs, in our view, there needs to be more than just a collection of businesses. And if it's just a collection of businesses, it's also more difficult to integrate.
Buy and build have a long history in private equity. If you go back to the 70s and 80s, and you know, firms like Forsman Little, Hicks Muse, even KKR, they started off as primarily buy and build investors. And I'm not sure I can add anything more than what, you know, James and Drew did, but one thing I will say is if you're going to do a buy and build, make sure you can build without doing an acquisition, because sometimes you may not be able to find the right acquisition. Okay, so, but you still have this platform company that you still have to grow. So I look at some businesses, I'm like, well, the only way you can really grow this is buying competitors, which is not really, you know, a great strategy, because quite frankly, you may not be able to find competitors. I think the best buy and builds are not just to get some cost synergies, but you also get some revenue synergies. Revenue synergies is not something I think a lot of private equity folks brag about, but in a buy and build that I'm currently involved in, when, you know, we buy smaller competitors, we talk about the revenue synergies as much as we talk about the cost synergies. Because at the end of the day, if you can't find the right acquisitions, you're not going to, and if you can't grow it, you have a dead end investment. And that's the biggest, that's I think one of the biggest challenges in a buy and build. It's easy to build because how do you get your pipeline of acquisition candidates? Easy. You send out a press release that you did this platform. Every investment banker in your CRM is going to think about you, and then suddenly the opportunities come through. But finding the first company, particularly the lower end of the middle market, you know, you're not buying something with infrastructure like an Apple. You're really buying a $3 to $5 million company with a great leader and probably an untested leader, right? Family-owned businesses. And I think you, as an independent sponsor, it's very important to give the support that these management teams need, particularly on the M&A side. But the other thing I'd always say, if you're going to do a buy and build, make sure you can build without doing an acquisition, because that's a big challenge. And because you may not be able to find the right acquisition candidates, maybe a little slow, and you still have this company that you need to run. So when you think about your investment thesis, everybody loves to say buy and build, but what happens if you can't find the acquisition candidate? I think if you can articulate that story well, you have a good investment and you can attract the capital for it.
Yeah, I want to jump on that actually, because I think it's critical. And when the question was asked, how many of you have done buy and build? I think roughly, you know, half of you raised your hands. I was at a conference recently, though, that was taking a look at deal volumes across the lower middle market and breaking them out into platform versus add-on. And over the last couple of years, what we've seen is as an inflection point where platform deals are now being outpaced by add-ons, right? Because there's a lot of competition, obviously, for the businesses that are 8, 10, $20 million of EBITDA. And as the competition increases there, private equity firms are increasingly being sort of driven down into smaller companies as sort of means of growth. And so if you haven't done one yet, you probably will, given the way the industry is headed in the future. And, you know, a point Drew made, the first point that Drew made is, as you're thinking about these, you need to back the right founder, right? And know kind of coming into your platform acquisition that this is somebody that we can back and we can fully support kind of moving forward. But I think the point that David made is really critical as well, which is you can't always bank on there being deals that you're doing, 1, 2, 3, 4 a year, because sometimes they're not there. Probably half of our clients I would consider to be pretty active buy and build investors. And where we've seen them succeed traditionally is when they have a real angle from an industry expertise perspective, right? A bit of a Warren Buffett, buy what you know kind of attitude. And then sort of backing the right person always, kind of comes into that. How do you sort of pool your knowledge with theirs, right, to execute on the strategy? And where we've seen them fail, frankly, is getting that piece wrong up front and then overestimating their own ability to close transactions in a post-close period. One we're working on right now has all the hallmarks of a buy and build industry. It's an asset-light, service-based business, very, very regional, relationships driven, sticky customer relationships. There's probably 200 companies you could buy in the space, all of whom sort of land in that $1 million to $3 million of EBITDA range. It is, a private equity dream scenario on paper. But when they got in there, they didn't understand the industry as well as they thought they did. And when they got in there and tried to start to execute right now they got their platform, they thought they got their guy, now we're going to execute on the build. And what they found was out of the pool of maybe 200 available companies in the market, all of which were founder owned, none of them wanted to sell, not one. And the process of bringing those folks to the table and getting them to understand the value and the opportunity, right, in partnering and growing their business into a larger network, they just vastly underestimated. They thought they could underwrite 6 or 7 deals a year. They're on pace to maybe do 1.5 a year if they're lucky. And they don't have the benefit of those revenue growth opportunities that David said, because they're hyper regional and very, fully penetrated in their regional markets. So now they're stuck. Right. And this is where we see probably, our highest percentage of buy and build failures.
To add a little color to that, we bought a business that was not a buy and build strategy, but we were opportunistically looking for add-ons. And a lot of the companies in this spaces were really small, $500,000 to $2 million of EBITDA. And the biggest issue we had was when you're trying to pay a guy $5-6 million for their business. They're just well, I'm making more money owning my company than I will selling my company. And we could really never figure out the right deal structure where these sellers felt like it was a good deal for them.
Okay, good. Thanks, guys. So next topic, let's talk about, and I don't know how relevant this is. I guess we could do a quick audience poll. We're going to talk about kind of how, and this doesn't apply to David or to Grant, but thinking back to when you guys were doing your first deal as an independent sponsor, how
definitely don't want to go back to those days.
Yeah, we're okay.
All right, but pro tips for those who are in that position, who are in a crowded marketplace, trying to distinguish themselves and create deal flow and get going in this process. What do you think about? What are the things you think back that made you guys successful when you were starting out, and what would you share with the audience?
Well, I became an independent sponsor, not necessarily by choice, but by circumstance. It was 2008. I was with a committed fund. We didn't want to raise another fund because the partners were operators. They wanted to go back being CEOs of companies. And, with my background, it's kind of obvious where I belong. So when I first became what was then called a fundless sponsor, there was a lot of discussion with capital partners of what we did. It was very few groups. I actually have to give a shout out to Peninsula here because they were really the first ones on their website to use the term, independent sponsors, fundless sponsors. But there were very few groups out there of capital groups that would talk to people like me. And then there were very few investment bankers that would talk to people like me. They're like, well, it sounds like you're a broker and you're just taking a fee for introducing a company to somebody else, which is kind of my job as an investment banker. And, the capital partners will look at you and they would say, well, I have a BD person, I'm getting the same deal flow. Why should I be talking to you? And those are the days that Grant and I do not want to go back to.
And you got pushback on, well, from the investment bankers on like, how are you going to get the financing? And why should I spend time with you, right?
Exactly. And I think it helps when you spin out of another private equity group. It helps quite a bit. And there were just a lot of phone calls. There were, suddenly, I was part of many major processes when you're part of a committed fund. And now you're chasing, the business broker in middle America, looking at deals. So, what I would recommend for new independent sponsors, particularly where you are right now, it's a lot different than what it was 15 years ago. You have quality lawyers, you got quality accountants. You don't have to tell anybody what an independent sponsor does. I know a lot of capital groups that will say, we back independent sponsors. They were not there 15 years ago, okay? And investment bankers like, oh yeah, I have a bunch of independent sponsors in the process. So it is a lot easier now than what it was 15 years ago. So to a lot of you out there, because we have quality accountants, quality lawyers, the one thing I will say is with independent sponsors, the quality is, I would say, across the spectrum. On one end, you have what I like to call a glorified business broker. Somebody who finds a deal, brings it to you, and acts like an independent sponsor, but doesn't really say much from the close to the exit. And on the other end is, something I like to at least think of myself as, is a private equity person without a committed pool of capital. And I think what will happen is, a lot of the capital groups look at you in a much more different light. Okay. And it's, I think, a lot easier to sign up a capital group. It's a lot easier if you can bring a little bit of capital into a deal, not just roll over a fee, but, bring what I like to call reputational capital, friends and family money. I think will give you a lot of credibility going forward.
Being a first-time independent sponsor is hard. It's hard for a lot of reasons. It's lonely. There's a lot of capital chasing deals. It's a long process to find out whether you're going to be successful or not. And I think what made my partner and I successful is we took a kind of a burn the boats approach, which was there was no going back. I see a lot of folks, independent sponsor, and they're like, well, I'm just going to kind of dabble in this while I look at other things. And I think it's hard to dabble. You have to be all in. And just getting a deal done is not being a successful independent sponsor. You have to be able to create value in these companies. And most independent sponsors, us included, we're not buying shiny things. We're buying things that need a lot of work. Can you all hear me okay? They need a lot of work. They need a lot of help. You got to build teams. You got to roll your sleeves up. And, it takes a long time to be successful at this. And a friend told me it's the greatest get rich slow plan. There's some truth in that. We just exited the first company we bought. And we started looking, the time of exit was 7-8 years. And there's no guarantee it's going to be successful. And you don't have that burn the boats mentality where you're going to work 6 days a week, 12 hours a day to make it successful. It's probably not the right career path. I'd argue being an independent sponsor is probably one of the hardest things you can do. You're convincing a seller to sell a business to you when they know you don't have the money. You're convincing capital partners to invest with you based on your vision and track record. And then you got to go motivate a management team to do something they've never done before, grow faster than they've ever grown. And it's a really hard road to travel. And if you don't take that burn the boats mentality, I just don't think you're going to be successful.
I think when I mean a new independent sponsor, that's one of the things that we counsel on is you need to be patient because it's not going to happen overnight. And our observation is
You don't tell them get rich slow.
No, I don't tell that, no. But it's a 2-year project. You need to be committed to to focusing on this. And as Grant said, you've got to be all in. and be prepared to do it for 2 years. A lot of them get done more quickly than that, but it's hard to find deals, full stop. Even with a committed fund, it's hard to find good deals and get them signed up on reasonable terms. If you're an independent sponsor, you've got an additional set of challenges. But burn the boats is actually a great, it's a great analogy, and be comfortable committing enough time and having enough personal liquidity to make it through that. There will be some speed bumps along the way. And then the other thing we see is independent sponsors kind of pick their partners early in the process. So both capital providers, because that is one of the biggest issues I think investment banks have in recommending to their clients to sign up an LOI with independent sponsors. Can they get the deal closed? So pick your capital partners early, and as well as your service providers. So if you go to the investment banker and say, here's my LOI, here's my private equity partner, maybe it's a joint LOI, here's the law firm that I work with, here's the QOB firm, here's the insurance due diligence firm. You've got that all laid out. It brings a lot of credibility, and you want to take as many of those issues off the table as you can.
Yeah, I think they said it. I think all three of the gentlemen up here just said everything that needs to be said, but I'll throw two other things in there that I think. One that I think independent sponsors underestimate that they have over the competition. And then the second piece is something that everybody should think about doing if you're a first-time independent sponsor. And I'll start with the latter. The first thing is plant a flag in the ground. Build a thesis, develop an expertise, or if you're looking at deals more agnostically, get really smart on the companies you are looking at and the industries and the trends. Because one of the things that we see is people that are just, I'm agnostic and I just look at deals and I'm good at looking at deals. It's hard to differentiate yourself either with capital providers or with sellers if you're just kind of an agnostic and you can talk. It's great to talk 30,000 feet about any company out there, and most of us in the room can do that. But to be able to really dig into the business and understand the business and the operations, sellers can actually see that. They can tell who really understands their business, and capital providers can understand who really understands the businesses they're buying. And so plant a flag in the ground, even if you got 3 or 4 flags in the ground or theses that you're working on, but plant some flags in the ground, get smart, talk to people, really figure out how can I know more than other people that are doing deals in this space. And so that's one thing that I think first-time independent sponsors can do that can differentiate themselves. And the second thing is that, and Grant kind of alluded to it earlier when he said, we're kind of taking more of a defensive approach this year, taking our time. Independent sponsors have time on their hands. Now, some of you would argue that that's not a benefit, but to me, if you're a committed fund, you've got that kind of, you have to put money to work. You have to think about how efficiently and effectively am I talking to companies and talking to sellers, and how am I managing looking at 1,000 companies a year, however many you're doing. And so you have to be efficient. Sometimes you don't have the luxury of really digging in on something. Independent sponsors, if they choose, have the luxury to really not only dig in on the companies, but also build relationships with sellers. And I think one of the things that sometimes, at least from my perspective, I see is underestimated is that founder-owned businesses that have never sold businesses want to sell to people that they like and trust, okay? Because it's their business, it's their baby.
Is that our problem?
They really do, because it's their legacy, their people are like family to them. And a lot of independent sponsors that we see this all the time. And I think it drives some capital providers crazy. We get calls and they say, how the hell did this independent sponsor get this deal locked up at 4 times or 5 times? And it's like, well, they spent a year, 2 years, 3 years building the relationship with that seller. And that seller decided that they were going to be a good steward of their business going forward. And we see that all the time. And sometimes I think independent sponsors lose sight of that. They think, well, I don't have the money, so I'm at a disadvantage. I always think there's more than one answer and more than one side to the coin. And one of the advantages you do have is the ability of time and to build that relationship with that sellers, which the people with money sometimes don't have the luxury of.
I'd probably argue as an independent sponsor, we have an easier time around price discovery and a process than a funded sponsor. At the end of the day, we all have to win to buy a business. And a fund, kind of gets the same attention from an intermediary. When a fund is, when an intermediary is really excited to talk to us, that kind of tells us something a little bit about the process. And so we kind of know where the price needs to be. And so to your point, there's been a lot of times when we talk to our friends like James and Capital Partners, where they go, oh, we saw that deal. They won like 8 or 9 times. And we're like, well, we're kind of talking around a 6. They seem to be interested. And they go, well, why would they sell to you to 6 when they were telling me 8? And the reason is intermediaries call the 8 to 10 time buyers first, then the 7 to 8 times buyers, and they kind of work their way down the ladder. They don't really ever circle back to the other guys and say, hey, would you be interested in a 6.5 times deal? And so there's been a lot of times where we've been able to tie up a company at a much lower valuation than a fund can. And that's because we are an independent sponsor versus a funded sponsor.
One quick follow-up. I wanted to pick up on one of the threads. I think, David, you mentioned this in terms of capitalizing deals, and you mentioned reputational capital.
Mhm.
So I guess question for, maybe I'll turn this over to Grant and James. I mean, so from your guys' perspective, I mean, is beyond an independent sponsor rolling their fee into the deal, what about, scraping together some of that reputational capital? Is that something you guys do, Grant? Is that something, James, is important for you guys to see?
Yeah, we like to see it that essentially the dollar amount is less important than its relevance for the independent sponsor.
Yeah.
So if the independent sponsor has done several other deals before and has had some successful exits, and they've got a $10 million net worth and they want to invest $100,000, that's very different than the first time independent sponsor who's been struggling to get a deal done for 2 years and liquidity is depleted and they want to put in $50,000, but they have a net worth of $500,000. It's all relevant, right? What we just want it to be meaningful, and we're happy to work with partners who just roll a fee, but a vote of confidence of someone who's also willing to write a check and put capital at risk is much more meaningful.
I'll share a personal story. Our first investment, we'd spent about 12, 15 months sourcing, structuring, and closing. We'd invested a lot of money in that process. And we had a very understanding capital partner like James, who said, why don't you take this fee out at closing, which we were really excited to do. That deal had a 25x gross return. It was the most expensive money we've ever made. So I would encourage you to invest as much as you can in your investments. What you're taking out today could be a very small check compared to what you can take out tomorrow. And that goes back to the burning the boats mentality.
Yeah.
We're kind of to piggyback off what they just said too. We see a lot of capital providers as the markets evolve and more independent sponsors are in the marketplace, and kind of that spectrum of the independent sponsors is out there. A lot of capital providers are starting to use your ability to write a meaningful check for you, as James said, into the deal as kind of a qualifier of somebody that's really committed versus somebody that's really just hawking a deal and hoping to ride on the coattails of somebody else, and kind of that belief system as Grant just said, in your own deal and yourself and in the deal itself. So we tell people all the time, your ability to pull together some friends and family capital doesn't have to be just your money. Sometimes it's even better not to be your money because it speaks to those around you that know and support you. But I do think it's an important thing for independent sponsors to think about. We realize it is a spectrum, but it is something that we're seeing more and more.
Yeah, when you guys are doing a deal, right? A lot of time, I would say 90% of the deals that we look at, our clients want, it's a founder-owned business, and they're looking for the founder to roll, right? They want 20%, 30% roll. Why? Because they want some vote of confidence from the founder that this business that is backable, is going to grow. We believe in it. We believe in it so much, we're going to leave money on the table, keep it with the organization, and move this thing forward together. And you're, as independent sponsors, right? I think what we're saying is the signal is just as important to the capital providers and your other partners on the deal, right? How confident do you feel in this, right? And so some token, right, of your confidence in that reputational capital, I think matters. You look for it from your sellers, right? So I think that the community will sort of in turn look for it from you.
I'd probably add one more piece of advice, and I'm going to do a free advertisement for my buddies at Peninsula, although we've never partnered on a deal. These are long marriages between you and your investors. Thankfully, we've had good partnerships along the way. We've dodged some bullets with some bad partners that had a little bit better economics. You know, your success is going to be driven by your partnership between you and your investors. And so I would solve for that fit kind of above almost anything. And to James's point, get to know a handful of folks who invest in the space, build relationships with them over time. They need to see you say no a few times. It builds confidence, and it helps them understand how you think about risk and return. And you'll also understand what they're looking for. And it'll help you be more efficient with your time, that you're looking at opportunities that you can raise capital around.
Well put. So probably goes without saying, but if anybody in the audience has a question they'd like to pose to the panel, we've got a few minutes left in the session. So think about that. We'll circle back to it if anybody does. So maybe second to last question, and probably Drew, you're probably the best person to start on this. Selecting the right capital provider. I mean, actually, Grant, you just give a great plug for what you see as important from your perspective.
James called me dinner last night. Just kidding.
I will again.
Right. So, Drew, you want to?
Yeah, I think Grant started it off well, and I do think the partnership piece. I mean, when we're talking to our clients and we're looking at options on a deal, and if we've got a couple different proposals on a transaction, we always say, look, the partnership piece is just as important, if not more important, to your point, is the economics. And people get real fixated sometimes on the economics, and we actually see this a lot where people get kind of sucked into the dollars. And when we start a process, they're like, oh yeah, I want the right partner, and the money's important, but I'm willing to be flexible. And then all of a sudden you get a couple of proposals and a few shiny objects in front of people, and they're like, oh, I want that one, I want that one, I want that one, because it's a good number. And then they kind of forget the partnership piece. Now, fortunately, the people that we're working with on the capital side, we all think they're good partners. So, we think it's just about who's kind of the right match for that particular client, because everybody's different, and it is a marriage, and the personalities are different, and not everybody's a good fit for, a capital provider and an independent sponsor. So I do think you really have to pay attention to that partnership piece. And part of that partnership piece to me is really spending some time having conversations early on. When you get a proposal from somebody that talks about, look, how do you guys want to play in the sandbox? What's the role that you want to have post-close? What's the role that we want to have post-close? How do we all work together? Because to Grant's point, it's not a get quick rich scheme. It's the get rich slow scheme. And so if that's the case, you're going to have to be in bed with this person for a long time, and you want to make sure that how they want to work and how you want to work are going to be compatible. And one of the topics that we see all the time is this topic of control, and people get sucked into control, and they think if somebody wants control at the board level, they're going to take the deal away from me and all this. And everybody's fear is exactly the same from an independent sponsor's perspective on that. And I understand it, and I get it, and it's valid, and it's there for a reason. But I think as this market has evolved, there's groups out there like James and Peninsula that, they might say, look, we're going to need technical control on this deal at the board level because we've got the majority of capital at risk, but it doesn't mean we're going to be a bad partner. And if anything, we're going to be a great partner. And here's how we want to play in that sandbox. And so I think really spending the time to understand how people want to play post-close together, and the roles everybody wants to play, and to make sure it works, because every independent sponsor is different. Every the way you bring value is different. So kind of understanding that up front, I think, is really part of that key to success.
Right. Well, looks like a couple of last comments. We got to
wrap up here, but just, one thing to think about. Economics matter, but personality matters too.
Yeah. So
you as an independent sponsor should do due diligence on the capital provider that you're considering. And there's a wealth of the market is transparent. There's lots of investment bankers to talk to, or attorneys, or accounting firms. Check out the capital provider that you're talking about and find out how they are to work with. When the deal closed, did the capital provider push the independent sponsor aside? when things went sideways with the company, did they roll up their sleeves and help, or, did they seek to take a pound of flesh and, cram down your promote with new capital? There's a lot of different things you can look at, but I don't know why you wouldn't do due diligence on your capital partner, just like you do on the company.
I'll just add one comment that lines up with that one. The best thing we did was we found 5 or 10 other independent sponsors that we became very close with, that we compared notes and say, hey, have you worked with Peninsula? Have you worked with this group? What's been your experience? Where do they have flexibility? Where don't they have flexibility? That was probably the single best thing we could have done.
Yeah.
And I would encourage any new independent sponsor to kind of build that peer network.
Yeah. All right. I think we got to wrap it up. Dave, you have one last quick comment? Otherwise, I think we got to.
Well, since we're all, praising Peninsula, we did close a deal with Peninsula. They were great to work with when times were good. And then in one of the sectors that I got them into an investment, we had to deal with, times were really, really bad, and they've been absolutely great partners. So a big recommendation to anybody
There you
looking
go.
for capital.
This was not a paid promotion.
Yes.
All right,
Should have
guys,
been.
thank you.